Alright, today we are going to talk about some companies who actually create businesses that do absolutely nothing. Absolutely nothing. And they call them special purpose vehicles, which are basically legal entities that actually own billions. But neither do they employ anyone, nor do they do anything. Nothing at all. And this particular SPVs, they are basically the invisible structures behind securitization, infrastructure projects, and private equity. Right? So, a very strange question. Of course, why would a company create another company in the first place which has absolutely no employees, absolutely no products, and zero revenue? No people, no operation, no goods, no services, no customers, no sales. Plus, they transfer billions into it. Right? So, why? Right? So, before answering the why, I'll tell you what they are used for. They are basically used for supporting world's largest projects. These companies, these empty companies, are basically helping in making sure one of the not one of the but all of the world's largest projects happen smoothly, right? At least in the finance terms, right? What projects am I talking about? I'm talking about infrastructure projects like highways, airports, power plants, securitization. We have talked about it in a video in which we had mortgage pools, auto loans, credit card debts. It's also used in aviation, where it is used for aircraft leasing, ownership structures, right? Also, private equity. We talked about LBOs as well, right? We'll also scrap another layer related to LBO today, right? It is also used in renewable energy projects like solar farms, wind projects, green bonds, project finance as well, right? But you know, before I answer why they are created, we basically have to understand the problem, right? Let's go back to the problem. See, there's one simple dilemma. Let's say I have a house, right? And let's say the personal assets totally are worth 80 lakh rupees, right? So talking about the house, the personal assets, they are safe, they are stable, nothing wrong with them. But the problem is, I also own a shop, a business, and the problem with that shop is that particular business has a very high risk of failure. I have invested 50 lakh rupees in that particular shop, right? For that particular assets, right? Now, the problem is due to the nature of the business being so prone to failure, what can happen if everything goes wrong, right? Just to cover their loans that they paid out, the creditors would try to seize my house. Sounds fair, right? They have to get their capital back, right? So SPVs basically helps in solving this particular problem. And how does it do that? Basically, what is happening is we are creating two separate entities. This is basically called ring fencing. And why it is called ring fencing, you'll understand. See, the problem that just discussed about, it was basically arising because it was a single company. I showcase that I own a house and a business. So a failure of one, which was most probably the shop, would affect everything. It was directly affecting my house. Right? And that's the problem. What I could do is create a SPV. The simplest form of SPV is creating a separate legal entity. So what would happen? One entity would own the house and another entity would own the shops, right? The actual business. So what would happen if my shop fails? Because that entity only owns the shop, everything that would be affected in this entity only. This is something that no one can touch, right? So basically what it helped in containing the failure which could actually affect my personal assets. right? So this is why it is called ring fencing, and this is basically the foundation of every SPV, right? We have different assets, different risks. This was safe, this was a haven for me, this house was a safe haven for me. Shop was something that was risky, right? So what I did, I separated it into different legal boxes so that I can save my house, right? Now, again, why not keep everything in one company, right? Let's understand this with a very big example, right? You don't actually make a separate entity for your house, right? So let's talk about infrastructure projects. Let's talk about construction company, right? Let's say a construction company has to start a airport construction, which is approximately going to cost or worth around 20,000 crores, right? But when we're talking about construction company, what is really happening is a construction company usually is not depending on one single infrastructure project, right? They are totally focused on various other projects as well, right? But when we're talking about such a big project with such a big risk, right, of course with this amount, risk is absolutely next to your plate, right, or maybe in your plate. So the problem is, if everything sits inside one company, it would end up in first of all affecting itself if the risk comes. But because of leverage, the risk would create a chain of events, a chain reaction which could eventually affect the other successfully going projects as well, right? So in minds of investors, what would happen, they would see an unlimited exposure to risk. This would make the lenders less attractive towards our project, right? And eventually the deal would become impossible. So rather than containing that project inside your parent company, the construction co, which is the parent, you create another legal entity, SPV, for that particular airport project, right? So every asset that is associated with the project, all the cash flows, all the investors, everything is transferred to that particular entity. So when we want to invest in an airport construction investment or a project, we are totally, see, if we are investing in construction co, we are also having the whatever the responses or maybe whatever is happening on other projects of construction and co, we are being affected by those projects as well. But when you're creating a separate legal entity which is only focused on airport project, we know the risk, we know what we are entering into, and we only have to focus on that particular project, right? So it helps in basically isolating everything. So this is good for investors, right? Investors basically love separating their risk so that their risk is minimized and they have full knowledge about whatever is going inside. See, managing 20 projects at once is not something that everyone could do, right? So basically SPVs are financial firewalls, right? They are containing those particular risks associated with one particular project, right? So we'll see that mathematically as well, why actually investors love SPVs, right? Let's the parent company have assets worth 100,000 crores, right? And they have to undergo a project which costs 10,000 crores, right? But the problem is, without SPV, the risk exposure is basically 100% of parent's asset. If this project fails miserably, right, what would be directly impacted? The assets, the safe assets of the parent company, right? So in terms of investors, what would happen, that the downside is unlimited. It could directly infiltrate the assets of the parent company. So this is why lenders hesitate. But with SPVs, what happened, there is one entity which is the parent company, and then we have the second entity which is the SPV, which is basically containing all the risk, cash flows, investor, investment, assets, everything in one particular entity. It is separate from the parent company, right? So now project cost is 10,000 crores. What would happen? Parent equity would come in at 1,000 crores. Let's say 10%. It could be 2,000 crores. Let's say it could be 20% as well, right? They could raise external debt of 9,000 crores. If you have seen my previous video, you can understand this particular concept through the LBO video, right? This is what happened in the LBOs as well. This was what was actually happening. We bring in our equity, we get debt from lenders, right? So basically, with respect to the parent company, what is happening, their loss is only up to 1,000 crores, right? So the project is independently financeable, right? We bring in debt, the debt is supported by the cash flows that the project is going to give, right? So investors could basically evaluate the project separately from the parent companies, right? If the parent company is actually dealing in something which is very risky, and this particular project is something that matches the risk profile of the investors can fearlessly invest in that particular project, irrespective of whatever the parent company is doing, right? So what SPVs help is they help in unlocking massive capital for a single project, right? That particular lenders, those particular investors have to worry only and only about that project for which the SPV is created, right? So analysis become much more easier, right? We have also seen the role of SPVs in securitization. I've also covered this particular topic in the video, securitization, right? So what happens in securitization is basically, see, banks give out loan. That is the main purpose of banks, right? I have also talked about banks in those particular videos, that the reason why deposit exists is because there is a need for loan. Loans does not exist because there exists deposit, but it's the other way around. That's the economist definition, right? So banks basically give out loans, but the problem with loans is the time duration, right? We give out auto loans, we give out mortgage loans, right? They could range between 1 to 5 to maybe 20 years. Bank doesn't have time for that, because the main purpose of bank is to create money. But if the money that they have is already trapped for 20 years, that would actually decrease the efficiency. So what would they do is they would create, basically they would securitize and make mortgage pools in which investors can actually get their share, right? So the problem is, if the bank is not separate from that pool. See, if the investors is investing in let's say mortgage pools, they don't want to invest in auto pools, right? But if the bank is the one owning those particular security, the parent company is not separate. The bank is the parent company here, and it's not separate, that particular security. What would happen? The investor have to worry about the bank itself, right? They have a worry in their mind, what if the bank actually fails? If the bank actually fails, the asset pool is nothing, right? It's totally gone, right? So it is basically affecting how safe the investment are. So what happens is, whatever the mortgages the bank is holding, with the help of SPV, what they are doing is basically they are transferring, they are creating another SPV for that particular purpose, and basically transferring all those pools to that particular SPV. So now the SPV is the one who owns the loan, even if the bank cease to exist. See, investors are in for 20 years. If they are talking about mortgage pools, they are in for 20 years. They don't have to worry about if the bank exists or not, because even if the bank ceases to exist, what will happen? The SPVs will continue to survive, because it has nothing to do with the parent company now. It is totally separate. It is not affected by the bank, right? So now SPV is the owner of the loan, right? And now SPV is the one who is issuing securities. So now investors only have to take care and think about their mortgage pool in which they are investing, and not the bank's future problems, right? So now SPV becomes the legal owner of that particular asset only, for which he was actually willing to invest it, and the risk is isolated. Remember, risk is not ceasing to exist. What is happening is, risk is getting isolated, right? So let's talk about SPVs in infrastructure, right? Let's talk about toll road projects, right? So what happens is, let's say for a particular road construction, the project cost is 5,000 crores, right? We, a parent company, has created an SPV, and for that particular, they have brought in the equity of 20%, which amounts to 1,000 crores, and they have a debt of 4,000 crores. Right now, what the toll is actually doing, it is bringing in a cash flow of 700 crores. So what will happen? The SPV would collect the toll revenue, they would pay the debt services, and whatever profit is left, it would be directly transferred to the investors. So the parent company who actually made the road has nothing to do its future. The future of that particular company now has nothing to do with the SPV that is created. It exists on its own, right? So this entire financing methods often depends on SPVs. See, for these debt to come in, for those investors to come in, for this equity to come into place, we have to make sure that the lenders are confident in that particular project only. They don't have to worry about what the maybe shareholders or the stakeholders or the owners or the CEO of the company that is creating the role. See, basically they want to get rid of the unsystematic risk, right? Whatever is happening within the company, they don't want to be affected by this, right? If the board of directors are not getting into a conclusion regarding the future of the company, they don't want to care about that. They just want to make sure that they are benefiting from the only thing that they invested in, which was the toll road project, right? Let's talk about SPVs in private equity, right? This is where the LBO part come in. See, for that, see, when we're talking about a private equity firm, and especially a big private equity firm, we can't expect big firms to only focus on making a particular one company efficient, right? There are multiple projects that are going on in that particular company. Now, if, see, not every company that they acquire has the duty, that particular company doesn't have the duty to be successful, right? They are investing in different industries, they are investing in different macro environments, they are basically trading cross borders as well, right? But I am sure about, see, I am talking about in respect of an investors, I only understand the risk associated with, let's say, company A. I just know and have a knowledge about all the risk, all the cash flow, all the things that go in this particular company A. I don't want to be affected because, see, these are all the projects that are handled by company X. Let's say this is company A, this is company B, this is company C, right? I only understand company A, but if I'm investing in company X, what is happening? Whatever the portfolio of A brings in, B brings in, and C brings in, right? I would get the cash flows if I'm investing in X based on all these three, right? But what if I'm not sure about company B and company C? I don't think this is a successful project. I don't think it's a valid acquisition, right? I only want to invest in A. Why should I get the rewards or maybe the risk associated with B and C? So this is why they create a separate acquisition SPV. They create a new entity specifically for that particular deal, right? And the target company is basically acquired by that particular SPV. So what is happening? The risk is contained, right? A better financing structure is established, right? Debt can be raised as at the SPV level. We are talking about only and only company A's SPV, which we actually understand, right? So there is a clear security for, so, and also the ownership clarity, right? It creates basically a clean ownership chain for future exit or IPOs, right? I know if this particular SPV goes private, I'll be getting the money back. Of course, if the IPO is offer for sale, right? I'll be the one getting the cash flows. I'll be the one who will be exiting, right? But if you are investing in company X, I'm not sure about it anymore. I might not, right? So there's a ownership clarity that is being created, right? So for now, whatever I have talked about, I believe that I might have led you to believe that SPVs could be created with the press of a button. Right? You create a SPV, you create a legal entity, you transfer all the assets, and everything is done. I might have made an image that SPVs are quite easy to create, right? But it's actually not, right? I have talked about theory in which you create an entity, you basically move the asset, you isolate the risk. It's clean, simple, and powerful. But what basically happens is we have to consider a lot of legal costs. See, we are creating a separate entity in which we are basically pouring billions. So it's not going to be easy. We have compliance burden, we have tax complexity, we have lender negotiation. We have to make sure that the reporting is ongoing, and this is basically what we call the friction associated with the SPVs. Right? SPVs are definitely useful, but not every company are creating thousands of them. Right? We have to make sure, if we are creating an SPV, we have to make sure that creating an SPV would help in reducing the risk, or it should help in creating financial efficiency. Right? So SPVs are definitely very powerful tools, but they actually come with real friction and the occurring or ongoing costs. So we have to make sure we understand and make the numbers match in terms of if the SPV that we are creating. See, we have to go through all of these, right? So the factor, the return that we are expecting is either the risk reduction or we are getting efficient financing. This is the decision that we have to make, right? This is basically the opportunity cost, right? So now let's talk about in terms of case study. Let's talk about the process of aircraft leasing, right? So see, airplanes are actually very expensive, right? The ideal range is around $50 million to $400 million, right? Now the problem is, if the airline itself is owning that particular asset, if the airline itself is owning that particular asset, it is a very big problem. See, the business of airline is very volatile, right? It's very complex, it has a lot of leverage, right? Now the problem is, if the airline fails, right, and you have not created a separate SPV, right, what could happen? You lose your hands, you lose your share from that particular aircraft which actually costed you 50 to 400 million dollars, right? But if you have created it, you can actually repossess that airplane and basically lease to another carrier. All you have to do is paint it, right? You have to change the logo, and that particular aircraft which actually costed 50 to 400 million dollars could actually help you bring in maybe the cash flows from the lease obligations, right? So what is happening is, investors could actually get a clean title and a clear security over that particular asset, right? The aircraft is legally isolated from the airline's operational risk. It is a very risky business, everybody knows that, right? Now let's talk about renewable energy projects, right? What happens in renewable energy projects is that the company basically separates their farms, right? Whatever the farms that they are creating. See, when we're talking about farms, we are considering land, right? And with land, a lot of legal obligations and volatility or risk could come in, right? So we want to make sure that the renewable energy firm existing in the first place should continue its operation, right? So whatever the risk, whatever the cash flows, whatever, right, everything should be isolated, right? Investors can analyze only one project independently without the developers other risk, right? See, when we're talking about renewable energy projects, they could be investing simultaneously in wind projects, they could be investing in hydro projects, right? So if we want the if we understand the business of maybe the wind projects, So I should be competent enough to make sure that I invest in that particular project only, right? So what SPV is basically doing is making financing easier by bringing in clarity. Each solar farm has its own SPV, clear cash flows, easy to model. See the cash flows is different in solar, hydro and wind, right? We can't compare the cash flows of every one of them together, right? So this is basically creating a separate entity is helping it model easy. We can make a financial model much easier if we have an SPV, right? It is much easier to fund, right? And this is why project finance and SPVs are inseparable in renewables, right? Again, not everything is a golden spoon. Things can go wrong, right? They are powerful, but like anything else, they are not risk free. What are the risks associated with SPVs? See, the biggest risk is complexity. When we are talking about a company who is undergoing hundreds of projects, there are various entities that are created if we are following the SPV every single time, right? So this basically means more legal layers, more tax layers and compliance layers, right? And one mistake could actually affect everything and can create an compounded reaction to everything, right? Then we have the poor transparency. See, what were to understand this, let's go to the first example that we talked about, right? What is basically having in happening is this, in this particular scenario, is this shop. Basically there was one owner behind this house and this shop. This basically got hidden, right? On somewhere, due to the legal structure, this person who was responsible for both these things actually isn't transparent anymore, right? So so there is a transparency risk. It obscured true ownership and the risk exposure from regulators and investors, right? Then we have the hidden liabilities. See, it is very important that all the compliance is done as it should be. If it's not properly structured, liabilities can actually leak back to the parent company, which is called piercing the vein, right? It could actually end up, even after creating such a ruckus of legal obligations, tax obligation, compliance, everything, if it is not properly structured, it could actually end up leaking back all the risk back to the parent company, right? Then we have the asset valuation risk. This is a very very risky situation. See, let's say an asset that is associated with that particular SPV, let's say it was actually worth 10 crores, right? But due to overvaluation, the SPV showed an assets of 100 crores. Now what is happening, whatever investors are coming in, they are basically happy that we are getting an umbrella of assets worth 100 crores. But in terms of crisis, when actual liquidation would happen, then they will get to learn about that the actual assets value was 10 crores, right? This fake sense of relief that they were hoping for actually disappears into thin air, right? So there is a false security for lenders as well. Then we have legal disputes. We talked about that SPVs is not when we're talking about companies of such a large scale, it is not an ideal situation for them to just work in the city of their headquarters. We have to cross borders, we have to go international, we have to cover domestic territories as well as we could, just to make sure that we are able to exploit all the opportunities that we are getting, right? So when we are crossing borders, when we are crossing states as well, right, the jurisdiction changes. Like, it, the difference between jurisdiction of states could actually be entirely different, right? So things can go wrong quite easily, right? Then we have the regulatory arbitrage, right? The problem is some SPVs, see, everybody loves making sure that they can use loopholes, existing loopholes, as well as they can. They actually do until they're caught, of course. Right? So they could create SPVs primarily to exploit the regulatory gaps, which could end up creating systematic risk. Right? So, talking and giving you a reality check, SPV is not eliminating risk at all. What is actually happening is it is just isolating the risk. A particular risk associated with particular project is being kicked out to a separate entity. All you have to worry about is risk associated with that particular project. A project that you don't understand, its risk is not transferred to you. You don't have to carry the burden of the projects that you don't understand. Right? It basically changes the uh, it basically changes where the risk actually lives, right? And the structure can make the risk harder to see, but it never really disappears, right? So what smart question you always should ask is, where does the risk actually sit now? Right? You have to be sure about the risk, right? They're not always bright days. So understanding structurally in an economic environment, one asset, one legal entity. A single house, plain loan pool get its own company. At the basic level, this is happening. A single house, a legal entity. A plain, a legal entity. Separate. Loan pool, a separate legal entity. Risk is contained at the smallest level. Right? On a bigger level, a slightly bigger level, one project, not assets. Assets individually are not getting into separate SPVs, but one entire project is independently eligible to get its own financing decisions, like toll roads, solar farms, acquisitions. It becomes independently fundable, right? Capital can flow to specific opportunities only, right? When we're talking about macro, we are talking about the entire financial system. We are seeing securitization, infrastructure development, capital allocation across the economy is basically depending on the SPV's structure. So SPVs are basically sitting underneath much of the modern finance and infrastructure. We've talked about securitization, LBO in this particular video, and we have individually covered those topics as well. Right? So we have uncovered one more layer into the topics that I've already covered in detail. We have uncovered one new layer to it as well. Right? So now coming back to the first question that we asked, why create a company that owns billions but does almost nothing? It's to safeguard that particular asset. It's to transfer them to a new legal entity. It's to make an empty company called SPV. It is to isolate the risk. It is to make sure that there is efficient financing. It is there to make sure the investors are confident enough to participate and capital is flowing efficiently. So, an SPV's job is not to run a business, right? It is not doing anything, right? It is basically a legal boundary around a specific asset, micro level, project, meso level, and a pool of cash flows. So SPVs itself, they are not creating value, they are basically creating structure. And in finance, structure are very important because it actually helps in determining and making clear that who is actually bearing the risk, who will actually get the cash flows, and who would actually get the cash flows first. Remember we talked about in securitization, we talked about the tranches, right? Who actually gets paid first and who actually gets paid last, right? So that's why SPVs appear everywhere, from mortgages and highways to aircraft and billion-dollar acquisitions, right? So modern finance runs on cash flows. SPVs decide where those cash flows actually live, right? The legal trick behind billion-dollar projects isn't magic at all. It's a deliberate structure that is designed to isolate, help in finance, and allocate risk. Thank you so much.